Let's get more on Netflix's quarter. Bring in Gene Munster of Loop Ventures for more insight. Gene, what was the big headline here in your view?
Melissa, I think this concept of a great company, but not necessarily a great stock. And there's a ton of value that Netflix is creating for its users. We looked at the cost per hour of using Netflix, 37 cents, compared to cable TV at about $1.20, compared to reading a book at $7.11. No wonder why people don't read books. But the key takeaway here, similar to Karen's comments, is fantastic company. I also have been cautious on this as the stock has added, even with the pullback, $70 billion in market cap this year. And so I've been wrong on this. I do believe that we are crossing over a point with this guidance that the big takeaway is that essentially we need to start to fast forward and think about 2021 growth. And as you said earlier, Melissa, is that they've been pulling forward sub-ads. And so what that means is they've effectively crossed now what the original street estimate was for net sub-ads for the full 2020. And the next 2 quarters, investors are going to largely not be as concerned that, for example, subs be down 50% in the September quarter, or might be down 20% again in December, but really start to focus on what is the net sub ads once we've anniversaried all of this. And I believe when you step back, and this is the distinction between a great company, which Netflix is, and I don't believe will be a great stock over the next year. I think when you step back and think about that growth in the beginning of next year and put it up against other companies that also are delivering a lot of value per hour, companies like Apple and what Amazon's doing with their streaming services, TikTok, Peacock, all of this, I think it's going to be difficult for Netflix to be raising prices. I could be wrong, but if they are unable to raise prices, I believe the multiple will compress.
Isn't there a benefit, though, to Netflix achieving greater scale sooner? I mean, doesn't greater scale mean more market share, meaning putting more pressure on competitors, whether it be incumbent TV or other streaming services?
So the flywheel in the case of Netflix has been financed through debt. They now have about $16 billion in debt, a detail that is often overlooked. They have about $7 billion in cash. And so this is a unique large tech company that is net cash negative. And I think about that flywheel, ultimately, Melissa, I believe that it's about great content. Great content in the context of the consumer. I don't necessarily put TikTok content as Emmy Award-winning content, but nonetheless, it grabs people's attention. And so this flywheel that we talk about, that you're referring to, I think in the case of Netflix, it is funded through debt. And separately is I think that consumers' appetite can be fleeting when it comes to content. And I think Netflix is going to be around a long time, but I don't think that those type of businesses should garner 100x multiple. I come back and think about a name that I still feel is greatly underappreciated, which is Apple, and that trading in the low 20s multiple versus Netflix at 100. Hard for me to be optimistic on Netflix.
You said 37 cents an hour for a Netflix user for entertainment versus like $7 plus per hour for a book?
Correct.
Wow, that's a huge differential. Gene, always enlightening. Gene Munster of Loop Ventures. I don't know, Guy, I think people don't read books because they're lazier these days in general, but, you know, that's my own opinion.
I love reading, but are you kidding me? I'm a book guy for sure.
I can imagine.
But I'm 73 years old, so, you know.
In terms of the bear, because, Guy, you're in the bull camp, I'm just wondering, you know, the argument also is that as people stay at home and they binge more, they've gone through a lot of the content. I mean, I know Tim's watched Tiger King or whatever that's called 8 times in a row. And he's now looking for more content, and they will have to spend more in order to replenish that content for all of those demanding viewers.
Yeah, no question. Listen, I understand. I totally get the bear case without question. But I think you would acknowledge that, you know, the same arguments we're making now in terms of, you know, spending more, we could have made those arguments, you know, a few years ago, and obviously a lot lower in terms of the stock price. To Gene's point, at a certain point, it's going to catch up with them, I guess. I don't think we're there yet. And last time, I believe Netflix reported, and I'm about to do it, I'm about to pull Steve Grasso, I'm going to do a would you rather, you know, would you rather Disney or Netflix? And I said Netflix, and I'll say it again. I don't know where Disney is in the after hours, but my sense is it's probably lower. which I think speaks volumes. I think Disney went higher on the Netflix move up, and I think Disney might go lower on this Netflix move lower. So I think Netflix is the beta play here.
Disney is down 0.8% in the after-hour session. Also got a downgrade from Cowen, who predicts that the park revenue won't return to pre-COVID levels until full year 2025, which is quite some time away. Tim, I don't know if you want to participate in this would you rather shenanigans, but go ahead.
We've established, Mel, that I follow rules on this show, and I am not initiating would you rathers or would you rather rathers. Like Steve and Guy. But I'm really happy to have these guys try to pull Disney and Disney Plus into a Netflix valuation. You want to do that all day long? Disney shareholders love that. So you can't tell me Disney's going to suffer on the downside when it hasn't really participated on the upside. And if it does, I'd much rather have a blended multiple that gives me, 1/2 of the Netflix multiple for that portion of my business that is Disney Plus by 2023 and back it into present value. You're still getting benefits. So the Disney issue is the pace of the recovery of our country in terms of COVID-19, and I don't think theme parks and consumer experiences are going to be normalized in the next 12 months. How can they be? Flywheel, let's use it one more time. That's the flywheel for Disney, is ultimately their studio, their theme parks, and their consumer products are all meshed into the same flywheel, and without one of them, they suffer.
Karen, if you had to ask a question of CEO Reed Hastings or his newly minted co-CEO Ted Sarandos on the I don't want to say conference call because it's not a conference call. It's a pre-taped video that will drop on YouTube at 6 p.m. So if you had the opportunity to actually ask a question, what would that be?
I think it would be what's the saturation point for viewers and what they're willing to pay in monthly subscription, not just for Netflix, but for all of the streaming competitors. Where do they just get tapped out and they can't pay anymore?